Welcome to BTFDtv. My name is Jack Barnes, and if you've ever watched this show before, you know that I'm going to turn to my co-host in a few moments and unleash him on the absolutely interesting topic of politics in Washington, D.C. for about 45 seconds before I arbitrarily cut in. So, Uncle Bob, what do you got?
Yeah, well, I mean, as you well know, in the States here, we currently are in an election cycle. So Congress is away. They're not dealing with these things other than on news shows and at various campaign events. Meanwhile, in Washington, the president hasn't been in Washington much. He's been raising funds, although not doing campaign appearances is notable, given his anemic ratings at this point. The interesting thing to report, other than Ebola, which I'd like to make this an Ebola-free show, basically, but is with dealing with ISIL in Iraq/Syria. The developments there, or the major development from my perspective, was that ISIL had substantial forces within about 8 miles of the Baghdad airport, and the Iraqi military is in such a mess that they were not able to organize any counteroffensive to that. And apparently we had Apache helicopters up attacking them. Fending them off. It's a little ridiculous. The whole boots on the ground argument, we could talk about that until the cows come home. The president's ineffectual. His generals, both current and past, are kind of indicating the same. Here we are stuck, and mind you, I am spending time studying the Illinois state legislature, finding out who our next president might be.
Yeah, okay. You're all over that one, huh?
Indeed.
So, welcome back, Australia. How's the bubble out there, and is it deflating?
Well, let's say, since we last spoke, iron ore's taken this rather beautiful swan dive. I think it was still in the 90s when we last spoke per metric ton, and now we're getting down to the high 70s, back up to a little bit around $80. But it looks like Australia's built an iron ore operation to cater to 2 planets. So we've got a bit of a problem there. And in terms of the housing market, well, we had something quite unique happen 2 weekends ago. We had the median auction price of all the homes sold in Sydney of $1 million Australian dollars. So if you could imagine that, that's pretty expensive when you think about it compared to anywhere else in the world. But that's the reality when you got a banking system that's very willing to lend. But on the back of that, while the rest stock markets across the world fell 4%, ours fell 8%. So it looks like if this downturn, at least this pullback in the market, it's affecting Australia, at least on the stock market, a lot more than it's affecting most other countries where, it's perceived that they have a lot more problems than we do.
Agreed. Jack, you're muted at the moment.
I'm muting because my dog is talking to my family at this moment.
Fair enough. One of the things that I was hoping that you might provide us some perspective on, Lindsay, is just your view of China at this moment. I was at a conference, a stock conference held this week, and had an interesting speaker, speak a little bit about China and just the problems it faces. And I guess the natural impact of that, would be most severe on Australia.
Yeah, you're exactly right. I mean, we're the country that made the biggest bet in the West on China, just never-ending growth. And so, look, I think the Chinese are starting to realize that you just can't keep on building. You just can't end up having more apartments than people. I mean, that's what they were going to end up doing if they keep keep the same strategy they've had for the last 10, 12 years. But that seems pretty clear that there's excess stock. I mean, there's a real clear excess stock of apartments available in China, and I mean, there's 50 million.
5 months in a row, is it now? Is it
Yeah, 5 months in a row. Things are slowing down. The price of real estate is slowing down. We had someone from the Western Australian Treasury, the state of Western Australia, where all the mining operations are, finally take a trip up to China and have a look at what's going on there. And what he realised was there's a lot of construction, and he realised that there's a lot of empty cities, and inevitably there's going to be a pullback. You've got the city of Handan, which has pretty much gone bust. Realised they themselves admitted that they probably have enough housing stock for another to cater to population growth for the next 20 years. So that's just the first of a whole wealth of cities that are probably going to be offering the same news to the global media in the coming months, and it's going to be very interesting to see the reaction. I mean, you still have a mining industry here hell bent on increasing production. So what might end up happening here is we have this mining operation that's in the next 12 months 15-20% bigger than what it is this year, and but demand might start to reduce by 20-30% itself. And then what you end up with is mining companies either trying to figure out a way to break even by terms of creating more volume of iron ore, or they have to start to decrease and pull back on their production scale. But if they start to do that, well, the extraction cost per metric ton of iron ore start to go up very, very sharply compared to the investments that have been made. So in my opinion, the mining industry here is in a no-win situation, and you've got Rio Tinto and BHP who are the more cost-effective extractors of iron ore, but you still have all these other companies that are out there, and they could find themselves in a very, very bad financial mess in the next year. I mean, we already had one smaller iron ore company go bust in the last several weeks. So still at $80 a ton, which is still 4 times more than what the long-term historic average price is. So if you can't make money at $80 a metric ton, you've done something wrong.
Lindsay, is that going to have carry-on effects throughout the Australian economy? I mean, I don't really know the size of the mining industry. I mean, I know it's huge. That's all.
Yeah. Well, we're a roughly $1.5 trillion economy, and 80 billion of exports is pretty much iron ore. So you could imagine, you got that 80 billion being pumped out with the majority of which of iron ore being sent to China. And then so you've got the mining companies that get affected, and if the mining companies are affected, well, that affects its service providers. Well, if its service providers are affected, well, it affects the service providers that provide the service to the service providers. So it ends up just being like a camel's walk from northwestern Australia, the problem, to the big cities. And that takes a little bit of time to filter through into the greater economy. But I think the next economic figures are going to show that the exports of iron ore, even though we might be pumping out more iron ore than we did 6 months ago, it's not going for the same price. It's going for a lower price. So we may actually see a bit of a change in that. And the Australian dollar just simply hasn't fallen enough to make it look not as bad. And that's kind of something I think the Reserve Bank here was kind of hoping for. But once again, they've made a couple of bad errors in their policy, in my opinion. So I think we're gonna find ourselves in for probably a pretty rusty 2015 here in Australia, and that's because that's what happens when you don't use a calculator to make a forecast. It's as simple as that.
Well, speaking about trying to make it up in volume, Saudi Arabia is doing the same thing with oil right now, and what they've done is they've contacted their long-term customers, and they've always had these agreements that are built into them. There's a 10% fudge factor, so you could buy 10% less than what you had contractually said you would, or you could even overbuy 10%, because you sometimes need to balance your crude flows for a refinery. Well, they've contacted the Europeans and let them know you will buy 100%, or we won't supply you.
Wow. Yeah,
So,
I mean,
so the 10% slop's gone
yeah.
for what they're pushing.
Well, what's
And
very
go ahead.
Yeah. So what's very interesting about the Saudi Arabia and Saudi Aramco is if you've ever been to Saudi Arabia, you know that they have the most well-oiled oil and gas operation in the world. These guys, I mean, Shell and Chevron are jealous of their operation. I mean, it is that good in Saudi Arabia that I think that they can afford to, push around a little bit and get the pricing that they want, whether it's higher or lower. They have a very low extraction cost, but in saying that, a lot of the money that gets pumped into that they receive from oil, that kind of goes into the costs government spending, and so the Saudis are going to have to be quite cautious in the way they spend and the new dealings they make with their international customers. I mean, America's a dying customer of Middle Eastern oil.
Yes.
So
In
you're
fact, pretty much almost the only oil, I'm being general here, the almost oil being imported by the U.S. from OPEC right now is in fact Saudi oil being shipped to Saudi-owned refineries in the U.S., and they would be providing that oil to themselves anyway. It just happens that they own a refinery in the U.S. Theoretically, you can't pick up a refinery and move it, but theoretically that's kind of the driven demand there. It isn't U.S. intentionally buying Saudi supplies anymore.
No. And you also have the ADNOC, the Abu Dhabi National Oil Company, which I believe is sends America the second biggest private contract bill in the world, in America. So you have ADNOC there as well in the UAE, who's also a big supplier, but still on the greater realms of things, America is looking like it's well on its way to energy independence, and that's kind of a pretty good position to be in. You got all this natural gas. I mean, my company Green Rico in Texas, we're looking to set up our first hydrogen wind-powered hydrogen production facility to be able to supply maybe 40,000 kilos of hydrogen fuel a day. So there's a lot of companies out there, like small companies like Green Rico as well, who are in the game, trying to make America energy independent and a cheaper place to get from A to B.
Hey Jack, I have a question for you because I know it's an area of interest of yours. But what is the make or break price for fracturing in the U.S.? Like I've heard tossed around $90, but I don't know.
All right, so there's a couple of different things there. Hydrofracking pricing is going to be based upon the underlying geology that's being worked and whether you're doing a lot of stages or a few stages. So you have scenarios where, let's say, and I'm just making up numbers here, you're doing 30-stage hydrofracking up in the Bakken, but you might only be doing 10 in the Mississippi line. That's what I'm trying to reference here.
When you say stages is the key issue, right? Less stages, the better, right?
Well, no, this is completely dependent upon the geology and the necessary designs that the engineers put in for where they're drilling. But in simple terms, I think what you're trying to find is what is the unconventional oil price where there's pain. And I'm going to say that it's $65 is the real pain point. Bring it down to 75 and budgets will be cut down, but they're still going to be drilling and they're still going to be producing. Take it to about 65 and people will start penciling in slowdown numbers.
Any new offshore operation will start to go down. People will start to rethink building an offshore oil platform as well.
Well, offshore, I just know based on stock prices, offshore is like dying a quick death. No slow death there. Schlumberger, Diamond Offshore, they have been just getting clubbed like harp seals.
Yes. Offshore Brazil is some of the most expensive oil production on the planet and will always be some of the most expensive offshore oil production. and the demand for that oil may or may not be there at this moment in time. And that is more to do with an economic slowdown. Additionally, we've had so much oil taken offline during the Arabian Spring post period, while the U.S. has increased its production, that you have a scenario where, in the case of Saudi Arabia, let's say they cut 1 million barrels a day, right? They're not intentionally, but if they did, there's 1 million barrels a day that could be found to fulfill that and backfill that hole. They'd just be giving up customers.
Right. That's something I love for you to speak on a little bit more, because again, I just toy around in this area. I listen and follow some very smart people that speak to it. But they said that the fundamental cause of the decrease in oil prices right now, crude and Brent, is based not on demand. That demand is relatively staying stable.
It has.
It's all supply based, and that it's just cratering, and then of course exacerbated by traders.
Yes. Well, I mean, okay, Uncle Bob, in very simple terms, and I'm using very round numbers. Anyone watching this who's really into numbers will jump me because I rounded a number. But in simple terms, the U.S. has added 3 million barrels a day of new production and 1 million barrels a day of corn into ethanol. And that ethanol is a blending stock. So in that kind of context, you have a significant amount of new production. I mean, that's like a major OPEC producing nation arriving out of nowhere in a 3 to 5 year window. And demand hasn't changed. Demand relatively is stayed the same. There's been growth outside the U.S., but at the same time, U.S. demand is cratering because, quite honestly, a bunch of people bought a bunch of Prius equivalent cars, and they got rid of a bunch of F-150 Ford pickups, and the fleet went from low to high, and all of a sudden we can drive the same amount of miles and use a lot less gasoline. And so the U.S. has gone, in the last 5 years, has turned into, and no one talks about this yet, what I believe is the world's largest exporter of refined products on the planet. Because we're now exporting about 3 million barrels a day of product that's refined, okay? And I don't know of anyone else who's actually exporting in the 3 to 4 million barrels a day range. Maybe Russia. You know, and so it's one of those scenarios where, in my opinion, we don't have the setup that we had priorly. Okay, so this time you can't have Saudi Arabia just cutting, because you have supply from Libya that's looking for a new home. It hasn't had a home in 3 years. It's ready to come back to market. You've got oil in Kurdistan that's offline. You have oil offline in Iraq. Iran is under heavy sanctions. You have really piss poor management in Venezuela. You know, when you start to look at the bigger picture, there is, meanwhile, the U.S. is still growing production, and Canada is still growing production, and Australia is going to be growing production. So, you know, you kind of have a scenario where the Westerners are starting to ramp up production. The Middle Easterners are kind of blinking and going, we'll take any price. We're not going to cut our throats. Making a bad ISIS joke. So, you know, it's a scenario where we have a flood coming. And you need to flood the market now to get shale development in the U.S. It isn't going to stop, and it's not going to go away, and they're not going to be able to kill it, because there's been so much drilling and so much development, so much capital already invested in the Bakken. The Bakken's not going away. But what you can do is slow down the growth rate of the wells being drilled in the Bakken significantly until prices go back up. And then when prices go back up, so will activity. So you could say that the Bakken is putting a floor in oil prices. And from that perspective, I would say 65 is your big bump number. If it goes into the 64s and looks like it's going to stay there for a little while, you're going to have a lot less development in American shale development and unconventionals. If, however, this is a knockdown to 75 for the election cycle, and we're back to 75 to 95 by, say, February, March, this is nothing more than politics.
I agree. Well, let's get back to the great down under. So you see in the South, you live in the South, isn't that correct, Lindsay?
Yeah, I live in Sydney.
Okay.
Southern beaches of Sydney.
So you have not seen any implication yet of the Chinese slowdown.
Well, all we're seeing here at the moment is a little bit is the spot price of iron ore. So you got to remember this spot price was well into the hundreds, just 12 months ago or a bit longer than that, and now we're all the way down to the high 70s, low 80s. We have an Australian dollar that's used to be above parity against the US dollar for a couple of years, and now that's getting down into the 80s. So one way or another, it's getting more expensive for Australians who love to travel overseas. So, give it another 5 or 6 cents. Australians may want to start to consider taking their holidays domestically. But in saying that, no, I mean, people here are still thinking that nothing bad can happen to Australia, and it's a happy place, and property only goes up, and it's okay to go to the bank and get a 95% mortgage on a $900,000 home.
Wow, that sounds very familiar.
Yeah. So, but in saying that, there's a lot of the bubble talk here has grown a lot. I mean, I went to the Bloomberg Business Summit a few weeks back, and the Treasurer Joe Hockey, we had William Pasek was asking him the questions, and I was kind of lucky to be able to through an app send the questions you wanted to ask to all the politicians to William Pasek, and then he was the first journalist, I think, since in the last 16 months to ask Joe Hockey if he thought there was a credit fuel property bubble, and he said no. He said everyone's cashed up and buying homes. So everyone's a billionaire here in Australia. So we just all buy what we want because we all have so much money.
Oh, politicians are just the same everywhere. I mean, where do they breed these people?
You think that's funny?
For them?
And then you think that's funny. I fed the next question, which was to a politician, Kelly O'Dwyer, one of the younger Liberal members, who heads up an economic committee on behalf of the House of Representatives here. And so William asked her if the Australian banking system is going to suffer the same problems as Lehman Brothers did. And she had two things. Well, her first thought was the Sydney real estate market's still playing catch up.
Oh my God!
So I don't know what it's catching up to, but we're getting pretty close to the moon. We're getting pretty close to the moon. And then on top of that, she said, well, our banking system looks nothing like Lehman Brothers or Bernie Madoff. But once again, I don't think she's used a calculator or because here in Australia we're told our banking system is very well capitalised because they hardly add anything into their risk-weighted assets. So you could have a home loan where you've put 33% down with your own money, but you could still have a $700,000 loan because your parents helped you out with the other $300,000, and living paycheck to paycheck, and that's not considered a risk apparently here in Australia. The banks don't consider that to be a risk, so that's not on the risk-weighted asset list against the bank's capital. And then you look at how much cash they have sitting on the sidelines. Well, there ain't much of that either. It's all pumped into the asset profile of the banking system. So it's really interesting here. It's a laughing stock. And 2 weeks ago I was actually in Ireland having a drink with our good friend Mr. Brian.
Yes.
And it was we were having a good discussion about it. And after talking to people in Ireland, it's amazing just the way they just admit they were just nuts back in 2005, 2006, and no wonder everything went crashing down there. But you look at it here, it's a splitting image of you really feel like you're living in America 2006, 2007-ish now. It's people are starting to realise there might be a problem out there, but still, as long as the banks are willing to lend someone an awful lot of debt, there's always going to be someone to take it.
And then everybody will be screaming about the banks. But the bank. First off, banks. I honestly believe banks should be basically turned into utilities, for lack of a better term. That's what they should do. When they're sitting there trying to generate out of their market returns, not good things happen. I mean, our banks are still repairing themselves what, 5, 6 years after the fact. Still repairing.
Yeah. Yeah.
Well, here in Australia, we have 4 of the 20 largest banks in the world by market cap. Now,
I remember when Japan had numbers like that.
Yeah.
just making that comment. Keep going.
Yeah, but you know, it's funny here. I mean, I did a presentation as soon as I flew back from overseas. I threw on my suit and went into the city and made a presentation at this advisory firm for their clients. And I showed them all the data, and they were just like, they were just shocked to see the data I was presenting. But because everyone here just thinks the banking system's safe, but you know, for 4 banks in an economy the size of Australia's to be as big and as profitable as they are today, they each in their own right have had to solve the ultimate algorithm to ultimate profitability, prosperity that, you know, the banking system has been spending the last 500 years trying to figure out. And all of a sudden you had 4 banks in one country at the same time figure in their own individual capacity those algorithms, or they're all doing something very, very risky. And you know, the data suggests that they're all doing something incredibly risky. They're lending massive sums of debt to home buyers, whether they're looking to live in their own home or buy an investment property. And in Melbourne now, the net yields, well, there is none. It costs you, I think the net cash flow is negative 3% or something like that, or negative 2% on your investment property if you buy one. So if it's $600,000, well, it's going to cost you, if you buy an investment property for $600,000, even if you rent it out, you're still going to be negative $12,000, $13,000.
That's unbelievable.
Well, that's the reality,
right?
Yeah. Well,
I need to figure out whether I can short Australian banks. That
is like the most discussed trade on the planet that no one's pulled off right.
Yeah, you can put the bank, you can make a put on the banks, but I'm not too sure whether you can short them. But you can have a put on the banking system. You can have a put on the insurance companies that have insured all these very, very safe home loan, 98% leveraged home loans, and you know, so there's a lot of places out there where you can, you know, do it. And you know, 3 months, they're getting more expensive, but you know, 3 months ago some of those puts were actually quite cheap to get into, because everyone just assumed the banking system would go up and property prices will go up. But you know, we may find ourselves in a bit of a chuckle here, you know, in the not too distant future, and it's already starting to look like that just from the mere fact that you can't profit from renting an apartment, but everyone wants to get into the game. So that's the big thing that we have. I mean, for Melbourne, for you to get a net yield in Melbourne of $4.20 over a 12-month period, you need to, if you're going to go and buy a $600,000 investment property, you can only be leveraged at 34.3%. So you have to come up with the other 66% deposit to break even.
That's gonna be fun.
You know, I think the other thing that I heard this week, yet again, which I've heard you know, umpteen times, and then there was a comment since I've been back by one of the, I don't think it was Fisher, it was somebody else from the Federal Reserve Board, just basically QE is not going away in this country. It's a matter of time. We will allow approximately a 20% sell-off in equities, and then they will realize yet again that they have to come in and print money, you know, because they got to keep the system up. It's a
well, printing money is now part of the business model.
Yeah.
I mean, if you simply take away printing from the business model, well, you're gonna that breaks down the whole system. And you know, you just got to go and look at Germany and Europe. I mean, you know, Draghi spent trillions trying to pump this economy up, and what are you getting? Deflation. So we've got 2 problems. One is it's not working. It's just simply not working over in Europe. And in America, all this money has been kind of going into the wrong places. I mean, you could have built 50 brand new airports over that time and built a whole new freeway. You could have built a high-speed network between New York and LA, for God's sake. But this is invisible. This is money that Main Street's not seeing, and it's not But even still, America seems to be the best of the bunch. Your unemployment rate is lower than what it is here in Australia. It's much lower than what it is in Europe. So you could have a Wall Street bubble pop in the United States, but I mean, I would be very interested to see whether the Main Street economy takes another hit like it did before, because it's not very leveraged.
No. I mean, the leverage in the U.S. Consumer has actually reduced their leverage, relatively speaking.
Big time.
But
I mean, let's put it this way: there's more student loan debt now than there is mortgage debt in America. Okay, so we've shifted it to the idiots and the kids
that'll never pay it back, that have no means to pay it back, that have no ability to have ever shown income.
Without naming names, I have someone in my family who has a 6-digit college loan debt and will never make 6 digits in her life in a year. So, where does that go?
Yeah, there's going to be a lot of this is the big bubble you guys have, is the student loan debt. I mean, this is something that I think the rest of the world has no clue about, and people don't realize how expensive it is to get an education over in the United States, even if it is for a Bachelor of Liberal Arts, where that kind of doesn't take you far these days, compared to where all the engineers are graduating and getting good salaries over in the US. But it's going to be very hard for the broader American economy to grow. You just got this wage, kind of like here, you got this kind of wage stagnation.
Absolutely. I mean, the issue with student loans is kind of, I think, even to the extent that it's understood overseas, it's kind of misunderstood, and that's because they read headline figures like Columbia, Harvard, Yale, and they see, well, it costs $50,000 a year, and basically kids come out, but those kids get jobs typically. It's part of the huge problem that has occurred in this country, which is unregulated, nobody has dare lay a dime on it, is the for-profit educational system that basically is in the business of facilitating kids getting loans. Kids get loans, whether it's to junior colleges or these for-profit colleges, get the money, drop out. Take the money and run away. So it'll never be fun.
Yeah, you'll have just as much success. If they're going to throw $200,000 your way, you may as well do it to set up a business. But isn't that amazing in America, where they'll give you an absolute fortune 4 years before you can even start to work?
Yeah.
By going through college, but they won't go and give a business, a third of that. A penny to go and contribute to the American economy and create jobs. So
there's no loan growth in that area. In the small business loans, it's basically doesn't exist.
No. Yep. No. You need America needs, I think, a community lending renaissance where
it really does. I am so for that.
Where basically if you want a loan, you got these small banks. I go up to like Antioch, Illinois, just north of Chicago, and there's this little homegrown bank that If that bank basically, once a week had all its depositors come in, and you had startup businesses coming in and doing their presentation, well, at least if you're a depositor, you can vote to say, yep, okay, let's put money into this economy, into this business, and not that one. And what are they going to do? Well, when that shop opens up, well, if you're an investor in that business, theoretically through the bank, well, you're going to go and buy their cupcakes, aren't you?
Indeed.
Well, gentlemen, we've rolled right through the 30-minute cutoff. Normally we do hours, but this episode we're going to do a short one. I want to thank everyone for joining us. Gentlemen, do you have any last comments you want to make before we wind this up?
Just want to thank Lindsay for coming.
It's always a pleasure to be here, guys.
All right, well, we'll be back next week, and we'll have you back again soon, like in a week or two. So I just want to thank everyone for joining us. This has been the Macro Tourist Hour. We've had an Ebola-free episode, something we're rather proud of. I'm pretty sure no one expected that, knowing us. And on that point, have a great week, folks, and we'll see you next weekend.